This is part one of a three-part presentation covering additional inventory issues. The first we will cover is using the lower of cost or market and also using the gross profit method. So I'll explain the theory and then go over a few problems to show you how it's done. Net realizable value is the estimated selling price of an item in inventory, less reasonable predictable costs of completion, disposal, and transportation. We use net realizable value when the sale price goes below the original cost. However, we have a range that we have to look at before we can determine net realizable value. And this approach begins with replacement cost, then applies two additional limitations to valuing ending inventory. The ceiling is the net realizable value, which is the sales price minus disposal costs, and then we have a floor, net realizable value less a normal profit margin. Now here's the rule. A company values inventory at the lower of what they paid for it or market, assuming that market falls within the range. It cannot be higher than the ceiling or lower than the floor. So we have to go through and do an analysis to make these comparisons to come up with our net realizable value. So here is a visual demonstration of what this looks like. So again, what we're saying is that we know what we paid for it, and we certainly don't want it to be valued at higher than the net realizable value, which is the sales price minus any costs associated with finishing it and sending it. Or we don't want it to be valued any less than that same amount minus any profit margins. So now let's take a look at a little example, and we'll start by doing, in this example, we'll do product A. So here's how the thinking process we would go through. First of all, the unit cost is $7.50. And now what we're trying to do is compare this to an amount to see, does this fall within that range, our ceiling and floor. So first of all, we have to figure out what our ceiling is and what our floor is. So we're first going to take the estimating selling price, and then we are going to subtract any cost to complete. And that tells us that the replacement amount cannot be higher than $9. And as we look at this, we see the $8.40 is not, so it's okay. Now the next thing we have to do is we have to look at the floor. Now the floor, we're going to take that $9, and we're now going to subtract our profit margin. And that gives us our floor, which is $7.20. Based on this, designated market would be $8.40. Because it falls within the range of the ceiling of $9 and the floor of $7.40. Now let's walk through the other problems, the other items, and I'll show you how all this works. First of all, we had our selling price. We're going to subtract our disposal cost, and that is going to give us our ceiling or net realizable value. Then we're going to take off the profit, and we'll establish a floor, which is the ceiling minus the profit. Now we're going to compare these to the designated market to see if they fall within the range. Remember, they can't be higher, and they can't be higher than the ceiling or lower than the floor. So for our first one, we have $8.40. We already decided that that one falls within the range of $9 and $7.20, so that's the amount we would use. That becomes our designated market. Now we're going to look at the $7.90. It is higher than the $7.30 but less than the $8.50, so we would use the $7.90. Now we look at our $5.40. Our $5.40 is lower than the floor, So what we have to use is the floor. We cannot go below $5.45. Now we're going to look at the 420. That does fall within the range, so we would use that. And then our last is 630. It's higher than the ceiling, so we must use the $6. So now we have our designated market. Now what we're going to do is take our designated market and compare that to our cost. So we now have our designated market, and we're going to compare it to cost, and we're going to determine which one is lower. So for item A, it obviously is our cost. For item B, it's going to be the designated market. For item C, it's going to be, again, the designated market. For item D, it's going to be our cost. And for item E, it's going to be the designated market. So remember, it's the lower of, after we decide what the designated market is, we compare it to cost, and whichever is lower is what we're going to use. Now what we're going to do is figure out how much do we have to write down our inventory. So we're going to take that minus the cost, and that gives us our difference. And then we're going to take that times the number of units we have in inventory. And so in this case, it's telling us we have to write down $950. Now that could be $950,000 depending on the size of our inventory. Now, in terms of accounting for this loss, we have two possible ways of doing it. We can use the cost of goods sold method, which means we just debit cost of goods sold for the loss, and we do not show as a separate line item on the income statement. For the loss method, we would debit loss on decline in inventory if the amount is major, and it shows as part of other on the income statement. Regardless of the method, the contra inventory account balance after the adjustment should always equal the current year adjustment. So here is our example. There are two approaches. Again, we'll do both approaches, and I'll show you the difference. We currently have a credit balance in our contra balance sheet account of $250, and the write-down in total is $950. So remember, what we're going to do is write down the amount we need to adjust the account to $950. So in this example, it would be debit cost of goods sold for $700 and credit allowance to reduce inventory to market. If this is an unusual amount, then again what we would do is we instead would set up this separate account that would be part of other on the income statement called loss due to market decline of inventory, and allowance to reduce inventory to market. We'd use that same account. But again, after we do all of this, the balance in the allowance to reduce inventory to market should equal the total adjustment for the year, which in our example is $950. That completes how we would do lower of cost or market. Now we'll move on to the gross profit method. Now the gross profit method, the important thing to remember with the gross profit method is that this can only be used for estimating ending inventory during the year. It cannot be used at year end. So there are two methods. We'll look at these. There's the gross profit method, and again, this can be used for financial reporting because it's an estimate, but GAAP requires a physical inventory, because the problem with this method assumes that there is just an average gross margin for all goods, and we all know that markup is different for different products. Then there is the retail method. This would be used like for a Sears or a Nordstrom's. These are used by retailers to value inventory without a physical count by converting retail prices to cost. This can be used for financial reporting purposes, and we cover this in parts 2 and 3 of this presentation. Now, gross profit percentage. To do the gross profit method, you need to have the gross profit on sales. Now, in some problems, instead, they give you the gross profit on costs. So you always need to convert it, and this is the formula. You take the percentage markup on costs, and you divide by 1 plus the percentage market, and that converts it to the gross profit on sales. So an example would be, if in a problem you were given 25% gross profit on costs, you would convert that by taking the 25 divided by 1 plus 0.25, and that will tell you the gross profit on sales is 20%. Now we'll walk through an actual problem. This is the formula. First of all, we take any inventory plus purchases minus returns and allowances minus discounts, and that would give you net purchases. Sometimes they'll just give you net purchases, plus freight in, that gives you total goods available for sale. Then you have to calculate cost of goods sold, and that is going to be net sales. Remember, it's net sales times gross profit minus 1. And that will give you an estimate of your cost of goods sold, and that's how you end up with ending inventory. So now what we're going to do is we're going to work through a couple problems. Here is our first example. A fire destroyed the inventory at a company. Beginning inventory was 1.9 million. Net purchases were 5.8. Freight in was 400,000, and sales were 8.2 million. The gross profit was estimated at 20%. Now again, since we're given the gross profit, we don't have to do a conversion. So we would start with our beginning inventory of 1.9. We would add our 5.8 purchases plus our freight in, and that gives us total goods available for sale. Now we're going to estimate our cost of goods sold. We're going to take net sales times 1 minus the 0.2, which gives us 80% of that, gives us 6.56 million, and that gives us our estimated ending inventory. I'm going to give you one more example to make sure you understand this. Now in this example, we have a company, they had a fire, and they also have some leftover goods. So we're going to use our formula and figure out how to do this. Again, this gives us gross profit, so we don't have to do any conversion. So first, we're going to determine cost of goods available for sale by taking our beginning inventory, purchases, less returns and allowances. We get goods available for sale. We're then going to figure out our net sales. We're going to take it times our cost of goods sold margin, which is 1 minus the profit margin, and we get 256, and we get ending inventory at 85.9. However, we have goods on hand. We have to convert the goods on hand to cost, and we have to subtract out what we salvage, so therefore we'd be able to file a claim for $58,250. And that ends part 1 of additional issues for inventory.